Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views. Hey, good morning. Happy Thursday. No shortage of stuff going on today. Futures are lower. St. Louis Fed President Bullard suggesting that policy rate is not even in a zone that may be considered sufficiently restrictive, leaving the door open to hikes above 5%. In fact, he thought that 5% would be kind of a dovish approach, and thinks that we could go as high as 7 on Fed funds. This may be, in my opinion, maybe the Fed trying to cool the market, because the higher stocks go, the less restrictive monetary policy is. So it certainly seems like an attempt to cool the market, and which is going to work. But it seemed, I don't know, for me, it seemed like it was getting maybe a little bit challenged anyway, the current move. We took off our, you'll recall we had a triple Q position. I said we had a buy signal on that, I think a week ago, Monday. We took that off yesterday entirely. 8% gain, calling it good. We did also add to our short inverse S&P position, the ETF SH, and we added to some intermediate fixed income, just because the market, just to me, wasn't quite acting right. S&P, you've seen we talked about the Russell 2000 going above its 200-day moving average. Well, that's over. That's gone in reverse, gone down back below yesterday. Now it's going to open even further below today. So now you don't have any, the Dow, I guess, would be still the only major index above its 200-day. The semis fell back below their 200-day yesterday. They're going to make further retreat today. So it looks like we're just going to slosh around here for a little bit. The inversion in the yield curve is definitely screaming recession. Keep your eye on the 2-year, which is currently below 4.5%, nowhere near the rates that Bullard's talking about. The 2-year really kind of speaks to where Fed funds ultimately goes, and it's not talking about 6% or 7% or anything close to that. So we'll see what goes on there. Usually the bond market gets it right. It feels like we should be nearing a place where a more traditional relationship between stocks and bonds resume, meaning stocks down, bonds up, yields lower, as we edge towards recession. It does seem that if we're past peak inflation, we will get that relationship back. You will get that flight to safety into bonds at the expense of stocks as things continue to slow. So we're still kind of looking for that. There's some hints of it, but today doesn't look to be one of those days. NVIDIA, decent quarter all considering. We are not involved and not compelled to get involved. Continue to think semis have gotten ahead of themselves pretty decently, so I'm looking for a pretty good pullback there in the group, and I'd probably go semi-capital. We have air test still, AEHR. I've talked about that for quite a bit. We trimmed it several times. I think it got whacked by like 11 or 12% yesterday, just because it's had such a huge run and it's small and nobody knows what the hell they do versus other semi-capital, so they're going to take it down. But anyway, we'll add to that one, and we might buy some more candidates in potentially December if things get really a little dicey out there. Nat gas higher this morning. Cool weather making its way around the U.S. See if that holds. I still don't trust energy right here, right now. It continues to feel a little bit heavy. The nat gas move higher is a little bit encouraging, however. I do still like oil service on a pullback. Have an awesome Thursday. Talk to you tomorrow.
And now Now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with investment objectives similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.